Hey everyone. For those who don't know me, my name is Madhav Rajan. I'm the Dean of Chicago booth and the George Schultz Professor of Accounting. I want to thank all of you who have logged in for our first virtual Distinguished Speaker Series event of the quarter. And we have two fantastic booth alums, Ramzi Musallam and Hugh Evans from Veritas here. So this Speaker Series event brings high profile, as you know, leaders from business, from the government, from industry to come in, share their insights and experience. And we've had some great talks over the past couple of years with people like Tom Ricketts, Jenny Scanlon, Mark Hoplamazian from Hyatt, JP Gann, and others. And this year we've had, I guess, a couple of people in person. We had Howard Marks from Oaktree and alum Mark Levitt with Danny Meyer a couple of weeks ago, which was sort of fun. So let me introduce our two distinguished speakers today. So Ramzi Musallam is a founder of Veritas Capital's first fund from way back in '98, and he's the CEO and managing partner of Veritas Capital. This is a long-standing technology investor, over 50 billion of assets under management, and a very interesting focus of companies at the intersection of technology and government. So think aerospace, defense, national security, healthcare, infrastructure, and others. And this is a business that has been consistently recognized among the top performing PE managers in the world. If you look at data from Preqin, HSA, Paris, and Dow Jones, and they've generated an annual net return of over 30% since inception, which is just truly phenomenal. Ramzi was on the cover of the Forbes 400 edition for the 40th anniversary and was named recently in the Holy Grail of Investing, book by Tony Robbins, which is, quote, about 13 of the world's leading PE investors, each a titan in the field. Ramzi began his career at JP Morgan, worked in PE with Berkshire Partners, and then became a part of the investment arm of Jay Pritzker's enterprise in Chicago. We're also thrilled to have Hugh Evans. Hugh is also a managing partner at Veritas Capital. Prior to Veritas, Hugh was a partner and member of the investment committee at Falconhead, a middle market PE firm. Before that, a principal at Stonington Partners, and he began his PE career at Merrill Lynch Capital Partners. We're really thrilled to have Ramzi and Hugh here to discuss their careers in investing and their time at Booth. So Ramzi and Hugh first, welcome back to Chicago Booth.
Great, Madhav. I appreciate you having us on. And as I said, we look forward to seeing you in person in the not too distant future.
Thank you. Ramzi, maybe I'll start with you. I mean, you have a very interesting journey from sort of where you grew up to leading a $50 billion firm. So maybe could you say a little bit about your path and what were some of the pivotal moments that you faced along the way?
Sure. Yeah, I know. I guess a unique path in that I grew up and lived around the world. So my father actually came to this country first in our family to go to college. And after he graduated as a civil engineer, he took on work across the globe. And that led me on my journey. We spent some time in Jeddah, Saudi Arabia, and Riyadh, Saudi Arabia. We spent time in Mbeya, Tanzania, in the midst of turmoil in that country, but living, quite frankly, in the jungle, and also in Amman, Jordan, where I was born. And then, again, similar to what you'll hear from Hugh, my father was an entrepreneur at heart and decided that he wanted to, again, start a company. So he felt the best place for that was here in the United States. So we moved back here, went to high school in the United States in New Jersey, and but that background, I think, is quite frankly very important relative to my mindset and quite frankly, obviously, who I am, living amongst and in many different environments as a young person, and interacting with folks from all over and different types of cultures, I think is really important as it helped me see things, I think, in a very unique way. And it's kind of transcended itself into who I am and ultimately, obviously, what we've done here at Veritas. I'll briefly let Hugh also talk about it because, as I said, that entrepreneurial bent, you're going to hear about that today. Yes, we've grown, and now we have over $50 billion of AUM. Our first fund we closed in 1998 at 175 million. So the growth has been again, strong, but the ethos and quite frankly, the raison d'etre of who we are is really defined by that, cultural element that I just highlighted.
Yeah. It's by the way, it's really fun to be doing this as Ramzi mentioned, similar backgrounds. Both our fathers were civil engineers, believe it or not, and entrepreneurs. So in addition to being in the early 90s, during the cottage industry phases of private equity, Ramzi at Berkshire, and at that point, myself at Merrill Lynch Capital Partners, I think we arrived on campus coming up on 30 years ago this fall. And I think we met on day one or day two, and our backgrounds and our family backgrounds, were very interesting, and obviously, having that similarity as well as some good sports interest. We became very close at Chicago. But I'd say that's kind of underpinning. I'm originally from Toronto, from Canada, and like Ramzi, father, brother, his brother started multiple businesses. Same with my brothers who had been entrepreneurs. So when we arrived on the doorstep of Chicago, we kind of had that entrepreneurial upbringing and philosophy and bug, if you will. That was a big thing that we shared in common.
And did you two start working together like at Booth, right out of Booth, or how did that happen?
Yeah, no, it's a good question. Actually, we did decide when we obviously spent the 2 years together at Booth that we were going to, and it wasn't Booth at the time. I'm dating myself. But we did decide then that we were going to work with one another and partner with one another. He actually graduated a little bit earlier than I did, a few months, and he joined Falconhead and became a partner there. But the goal and the objective was to, as I said, work together. So when we were investing out of our second fund, which was a bridge fund, which is even smaller than our first, it was a $150 million fund. We felt that it was time to scale the organization, grow the organization. That's when Hugh came on board, and so it's been how many years now? Almost 20.
Yeah, 20 years.
And
this August.
So kind of as much from the ground floor as I could, as you can imagine, being a $150 million fund.
So just for the audience, feel free to submit your questions via Q&A, and we have some questions in already, and I'll incorporate them with others that I've prepared. So send them in. Maybe say a little bit about sort of what is the culture of Veritas, and how do you preserve it, maintain it, sort of keep it going over time as you get bigger and bigger?
Yeah, and I'll start, and then Hugh, please join. The culture for me is the most important driver behind, quite frankly, not only who we are, but the success we've had. You've heard us talk about that entrepreneurial spirit, and that's very important. In private equity, when you talk about 50 billion plus of AUM, you don't think about a very entrepreneurial setting, but we really empower everybody here to act as their own CEO, as a CEO in and of themselves, and to leverage this platform and quite frankly use the card that now gets you in with anybody to look at opportunities well before they become actionable. And we've got a number of stories that I think kind of reinforce that. So we are importantly investing in things that matter to us as well. That's the second pillar of really kind of who Veritas is and how we differentiate ourselves in the marketplace in private equity. Today, as Hugh mentioned, back in the 90s, it was cottage industry. There aren't that many firms. It wasn't obviously very, I'd say, sophisticated in many respects. Today, it's a crowded market. There's a lot of competition. We stand alone, and we are the only firm. Yes, we invest in technology, which is a very important part of what we do, but we invest in technology through a lens of investing in heavily regulated government-influenced markets. And those include areas such as national security and defense, healthcare, education, things that matter to every single one of us. And that's the other thing. We decided that we wanted to we started as a generalist firm. I remember going down to Huntsville, Alabama, and looking at a very high-tech defense electronics business, and really started to learn about that ecosystem. And that's really kind of the pivot point for the firm. Shortly after closing that deal in August of 1998, we decided that we wanted to focus. We would talk to our management teams and ask them the question, how do they differentiate themselves? And at that time, we didn't. But since then, we have. And we are the only firm in the world that can say unequivocally that we've stayed in this lane of, this ecosystem of, again, technology, high technology in government-influenced markets.
I think the other aspect to our culture that makes us very differentiated is, in addition to being entrepreneurial, we're also extremely collaborative, which is very unique. When you look across the broader private equity landscape, a lot of firms have decided to, build up specializations, divisions, fiefdoms, if you will, where they'll compete for resources at the investment committee level. We're very different. All the partners attend all the board meetings. All the partners are involved in all the decision making. And we do that in the spirit of transparency and then being able to leverage everyone's diverse backgrounds and perspectives. And it's that being able to fuse that collaboration with that entrepreneurship, I think is one of our key strengths.
So you're in a very complex space, right? Like, there's a lot of public interest, private investment coming in, like a complex issue like national security. How do you navigate that?
That's a very good question. And you know what? And we continue to learn how to navigate that. And quite frankly, as you obviously very well aware of, the environment we're in is very volatile. And, yes, new administrations, but again, we've been doing this for over 25 years. And really what I would say is, the simplicity element is very critical. When you think about national security, for example, we're investing in businesses and have invested in businesses that are of the highest sensitive nature that you can imagine. I'll just give you an example. One of the companies we own actually provides the President of the United States and has provided each and every President of the United States for the last 4 decades with about 70% of what he reads in his PDB, his Intelligence Daily Brief. We joke, we don't know if the presidents actually all read them, but it's there for them in their PDB. And all that analytics and all that data is synthesized by our company through systems across the world, geospatial and otherwise. And we provide literally instantaneous information and synthesis of that information. We'll talk about, I'm sure, AI and then all that comes with it, to the president and the cabinet members every single morning. So, what we do is critically important in that regard. And by the way, a byproduct of that is because of that, for example, I have a presidential level security clearance. I go through, an onerous process, polygraphs, and otherwise sometimes 8-9 hour settings. And the reason that I have it, and there's others in the firm who do have top security clearances, is because, for us, our approach is very different. And when you think about national security, we're not talking about just buying a company, putting it on a kind of, put it to the side and 5.5, 6 years later, sell it. We're transforming that business as we are in every one of those target industries that I mentioned. And you can't do that if you can't delve into, in this case, top secret and highly sensitive information so that you can actually make decisions on where you want to invest, where you want to deploy capital, where you want to focus. And that's really been a linchpin for us relative to our investments in that core area, which has been the longest standing area of investment for us in terms of national security. So the thrust really for us is, it's really kind of defined us. It's built on itself, meaning we continue to learn. We don't manufacture widgets. We actually develop intellectual property. And the intellectual property you need to invest in businesses in not only national security, but healthcare technology, education technology. Most recently, our newest vertical underneath this umbrella that I mentioned is Fintech. You need to have that IP and to continuously build on that IP. And you need the access to, information as a result of that and people in those ecosystems. And that's what we really are proud of. We continue to build on that IP so that our decision-making becomes that much more actually effective. And last thing before handing it over to Hugh, one thing I can say, which we kind of defy the laws of private equity, as you heard me talk about our earlier fund sizes, we're currently raising a $15 billion fund for our flagship vehicle. And, our returns have actually gotten better as we've gotten bigger. That is not, the laws of math sometimes, that defies the laws of math in certain respects, but our returns have actually gotten better as we've gotten bigger because I think, we've refined our IP. We have more tools in the toolkit to apply, that strategic transformational strategy playbook that I mentioned earlier, and that helps us drive returns. Our Fund 6, for example, is the single best performing fund, greater than $1 billion, bar none across the globe. And Fund 9, as I said, we're just raising now a $15 billion fund, and we continue to build on that IP.
Yeah, I think some practical data points from that. we were talking about machine learning in the early 2000s, cyber, well before it was called cybersecurity. Back then, it was called information assurance, data protection. Wasn't until about 2012 that Silicon Valley termed the coin cybersecurity. Space, I remember in the late 2000s, 2010, Ramzi coming back from one of these debriefings and discussing the importance that space was going to hold, not only from a commercial standpoint, but from a defense and national security standpoint. So, leveraging our access and our relationships allow us to kind of identify some of those macro trends well before they enter the mainstream. And just for everyone online, some may not know, going back decades, whether it's through DARPA or other departments of the US government, they have these investment grant programs where they will use federally funded dollars to start developing technology like the internet, like Siri, like Google Maps, decades before they roll into the commercial mainstream. So that's one of the other advantages of sitting at this nexus between government and technology.
Yeah, that's an important point. Again, the government, we talk about at tip of the spear, the government's at the forefront of technology, both in terms of investing, but in terms of collaboration as well. Not only from the iPhone, virtually every piece of technology on the iPhone, including Siri, developed in collaboration with government through these R&D programs. Google, the algorithm, the initial algorithm, Elon Musk's world, Tesla and self-driving and then autonomous vehicles, and then SpaceX, of course. So that's really why we decided that we needed to maintain that proximity to government in terms of, folks within that ecosystem. And we have and continue to build on relationships, in that regard. Every administration, I mentioned that earlier, we spend, for example, we've had numerous meetings with the current president and his cabinet members over the last, couple months. And, we do that so that we stay on top of, areas that could be opportunities, areas of risk that we can just be ahead of.
So we have a couple of great questions. Maybe I'll bring you one. It says Veritas has completed several deals at times where markets were more or less closed. So how has the team positioned itself to be able to identify, pursue and execute and secure financing when other firms are struggling to do that? So what is your secret sauce to the extent that you're open to saying something about that?
Well, I will say we are risk takers. I mean, we're in the business. We're a business of assessing and measuring risk. And what I will say, it's for us now, we've built a reputation. We didn't have it, when we first started. We're scratching and clawing and doing everything we could just to get deals done. But now we have the credibility in the marketplace based on our track record, and just high level track record is, we average, again, this is an average, 4 times return on investment, as you mentioned, net IRRs in the low 30s. One other element of our track record that folks, not only our investors but lenders, have come to appreciate is we don't experience volatility. Our loss ratio over the last quarter century is less than 0.5%. The average in private equity, as you know, is actually north of 20%. So we do have the ability to, quite frankly, utilize that to get deals done in environments where there is volatility. And it takes gumption, I think, quite frankly. It's easy just to sit back and say, I'm just going to wait till stability, the market's more stable, whatever the case may be. But yes, we have done a number of deals. And quite frankly, most of those have turned out to be our better, deals in terms of returns. And so I'd say it's really, for us, we talk about pounding your fist on the table internally. When you have the conviction, when you have the confidence relative to that conviction based on prior experience and based on knowledge and that IP, you can move forward. And then the market, obviously, with the credibility we've built, becomes supportive to a certain degree to enable us to get those transactions done.
Mm-hmm. Another question is, what concerns are you forecasting with respect to the recent push from some Silicon Valley investors to lift IP, copyrights, and so forth?
Can take that one.
Yeah, sure. With perspective to IP rights, it's critical to our investing thesis. I'd say that, you know, we are focused on very specific markets, and well over the last several years, call it the Valley venture capital investors have finally recognized certain areas that we compete in. Talk about aerospace and defense, for example. You know, that's core to our diligence, but most importantly, it's core to our value creation lever strategies in being able to, you know, protect the moats around our IP, and continue developing. You know, we've always lived in, frankly, being technology investors in fast-changing worlds. You're constantly worried about disintermediation around the corner. So being able to protect and to continue to develop the IP that our companies have is core to our investing strategy. You know, some other, you know, West Coast venture capital investors, and even in the PE side, come to investing a little differently than us. As you're probably well aware, not naming names, many of them focus on rationalizing cost structure. You know, taking money-losing, break-even businesses and turning them to 30% margin businesses. And that's important. We're focused on efficiencies and costs as well. But one of the big things we do differently is really invest in that IP. And in fact, in many of our investments, we actually increase R&D investing significantly from the start. There's many examples, and frankly, the reaction from our boards are pretty interesting, and management teams when we actually push significantly increased R&D spending. Again, those IP rights are critical, especially in as we look to the future, where we believe things that introductions of disintermediating technology is only going to increase in the future, of course, given the advantages of AI as it enters the market.
So maybe let's pick up on that. You said you were into machine learning much before everybody. And again, AI isn't new. I presume you guys have been into that from the beginning as well. Do you see the current cycle as more like just lots of hype, or where do you see this going?
No, I don't think it's lots of hype. I think there's a commercialization element. But when you think about it, you know, again, for example, when you qualify what AI is, we've experienced it through our portfolio companies at the highest levels, taking unstructured data, exabytes and petabytes of unstructured data from satellite imagery, and in real time, as I said, providing the president with analytics relative to, you know, key decisions that have to be made in very short periods of time. I think that, you know, symbolizes kind of what these types of companies, you know, do. We healthcare, you know, one of the things that we're very passionate about on the healthcare side is obviously fundamentally the U.S. healthcare system continues to be broken. We've been saying this for over a decade now. You know, that costs more, 50% more than the next OECD country, and yet quality of care ranks abysmally low. In some cases, 25th to 30th relative to infant mortality, average life expectancy, and other metrics. So we've been very focused on the utilization of data, which is that, you know, again, more important national resource, you know, more important than any other that we can, you know, we've been talking about this for years, and utilizing that data to make informed decisions to reduce that cost of care and, importantly, improve that quality of care. And a lot of our companies have been very much in that, you know, in that realm of doing exactly that. And we have many examples of just that. So, you know, I think what's obviously transpiring now is becoming more mainstream. But, you know, a lot of the technology that we talk about, you know, that we actually are at the forefront before it becomes mainstream. And that's why we spend a lot of time understanding the qualifications, the technology, the differentiation, the opportunities that they present, the risks that they present. But the difference now is that, you know, again, this is becoming more mainstream, and that's why the attention is obviously increasing significantly around what AI is. I'm a true believer in artificial intelligence and what the opportunity is. There's obviously a lot of risk around it too. It needs to be something that, as I'm sure you've heard in the media and otherwise, that needs, you know, you need some guardrails around it in certain respects. And, you know, that's going to be something that, you know, collaboration with government is going to be very important over the coming years. But I can see, for example, in healthcare, you know, a lot of opportunities to improve, you know, and move towards personalized medicine, which is obviously the objective to drive, again, that quality of care even better.
one of the questions that came in was just, can you give us just an example of a challenging investment decision and sort of how did you think about making that?
You know what? I will say every decision we've made is challenging. And I don't mean to belittle the question. I mean, I think we've done now almost 140 acquisitions. And what we've also done, by the way, we see probably about 500 investment opportunities a year. I'd say probably the ones that have made our mark are not only the ones that have been successful, that have led to the types of returns that I highlighted earlier, but quite frankly, the ability to say no and to be disciplined. And we say no in terms of moving on, on from opportunities, not necessarily because the company is not a good company, and not necessarily because that good company isn't valued appropriately. But if it doesn't align well to our strategy and our kind of approach to value creation, the strategic transformation element, we immerse ourselves in these companies. By the way, just to help reinforce what that means, we replace about 90% of the executive teams upon an acquisition.
Wow.
We ourselves actually have the formulation of what we think the strategy should be. And then we bring in a management team to align against that strategy. And then, as Hugh mentioned, we invest significantly over the first 2 years. A lot of time we'll get calls from our investors saying, wait, profitability is coming down, Well, that's to be expected. That's kind of our game plan. Invest in not only R&D, targeted R&D, but importantly, sales and marketing to open the aperture and move these companies and their technology into new adjacencies. And then you'll see step function growth thereafter. So the thrust for us is really, I think that kind of encapsulates, who we are in many respects as well.
Yeah, and I think it also, that approach of setting the strategy, and if you will, we buy the horse, an asset that we believe has been undermanaged, under-resourced, but has great potential given our strategy and a new team that we can bring in. But listen, we've made a lot of mistakes. We'll make more in the future. The key is learning from your mistakes and reapplying those lessons learned in future situations, because you don't always get it right. We sometimes laugh that one of the carve-outs we did, and given our strategy, we've done over 40 corporate carve-outs. We bought a business that we renamed Abaco, ruggedized computing business out of General Electric. And no matter how much diligence you do, how much work you do, how well you know that space, there are always blind spots, potholes. And in that situation, we laugh. One of the biggest ones were, GE back then was considered one of the gold standard training grounds for good corporate management and resources being applied productively. And one of the things we found is that was not the case. And so, but given our strategy, we allow for that kind of missing the mark, if you will. And that deal eventually ended up being a very strong four times return. But, being able to reapply your experience in future situations, that was not the last company we bought from GE. So again, it allowed us to sharpen our approach to diligence from that company. And obviously, subsequently, the GE has gone through a massive restructuring with themselves completely new management. But at the point in time, that was certainly the situation.
Yeah, and just quickly to add on, one of the easiest things to do is actually say no. You just say no, you move on. But I will say one of the hardest things to do in the world that we live in, when you're buying multi-billion-dollar, businesses, is to have the gumption to say, okay, the market is saying this company is worth X, and we're going to pay more than X. We're going to be the only ones out there that believe that this is valued 20, 30, 40% higher than sometimes the next bidder in the private ecosystem that we live in. And we've done that. And we'd like to just pay that dollar more or, dollar less, but, sometimes you've got to have the gumption around and the conviction around your strategy, your playbook, and the ability to create value. And just one, I think, interesting summary from that is the fact that on average over the last, again, 25 years, 130 plus 140 acquisitions, the average growth profile, the businesses we acquire is zero, flat businesses. When we sell those companies, again, this is organic. This is not tied to acquisition. But when we sell those companies, they're growing organically at 15%. So we've created a lot of, obviously, momentum for those businesses. We have conviction around what we think we can do with those businesses. We, quote, overpaid relative to everybody else, but then we end up with a strong return because we've done something with those businesses under our stewardship.
That's amazing. So given the business that you're in, one of the questions is, how do you balance the returns to your investors with creating something that sort of strategically goes in the direction that benefits the government, let's say, or society? Sort of how do you balance sort of various factors when you think about how do you manage these acquisitions?
Yeah, I mean, I'll say quickly. I mean, by definition, the areas we focus in, as I mentioned, are the most important areas to each and every one of us across the globe. You know, obviously, protection and safety of citizens across the globe, healthcare, both importantly cost, but more importantly quality, education tech. We've been very active in education technology, personalized education for students K through 12, and actually even into the college experience. And so I think what you'll, you know, kind of by definition, we decided to focus in on areas that are important to everybody and that make a difference through the use of technology across those ecosystems. And that in and of itself is really, you know, yes, we do focus on our limited partners, our investors, and making sure we continue to generate top decile returns. By the way, we have generated top decile returns in each and every one of our funds. We're the only firm in the world that can say that. And, you know, that is obviously a focus, but we want to make a difference. And that's why, just again, who we are positions us to make a difference in those environments.
One of the questions is about your recent move into fintech. You mentioned that you're gone in there. What are some things that are of interest to you in that space relative to some of the other areas you're talking about?
Yeah, you know, as Ramzi mentioned with that first deal back in '98, we started out in defense and aerospace. And really our approach to evolving over the years is identifying markets that are government regulated, that fit our playbook. So it's been a very measured evolution, you know, from DNA into healthcare, then into education, and ultimately fintech. And we, you know, similar to education, we looked at over 45 separate transactions before we made our initial platform investment. And it's in our DNA to approach that, learn, and wait for the right opportunity that fits our investment strategy. And that's what happened in fintech. We've looked at dozens and dozens of opportunity. And I think in respect of our first platform investment, it really fit our model. It was a carve out first and foremost. Again, under-resourced division, a lot of holes in the senior management team, but it really fit our mandate in the respect that we're going after a specific market of, if you will, small banks, credit unions, defined as kind of the underserved banking market in this country. They were, you know, well behind the major money center banks in adopting technology. And, you know, we found it very attractive to be able to invest and accelerate R&D and product development for those markets, to be able to take advantage of online banking, for instance, which is really what the core product is. But again, fits the markets that we go after. They're very large, with many, you know, small and medium-sized businesses, even upper middle market, a couple $2 billion. However, they work in very large markets where there's many large strategics, if you will, 10, 20, 100 billion dollar plus companies that, you know, as we strategically transform these businesses, not unlike our other specific markets, when you make a business more strategic in its ecosystem, you know, usually the strategics come calling. And that's why we've about 2/3 of our investments, which I believe is still highest in private equity, are sold on to strategics as opposed to other PE firms in what are called secondary transactions.
There's a great question that says, given that you have such a big portfolio of companies, is there much potential that you see for mergers or collaboration or IP sharing across these companies? Is that something you look for?
Yeah, we coin it power the portfolio. It's actually something that, and it's a great question, it's something that is not a nice to have for us, it's a must, it's a requirement. So we have a team here, obviously the deal teams themselves, but we also have a portfolio optimization team, also led by a Booth graduate, and Ashish Chandarana. And so the objective is to, because of, whether you're in national security or healthcare or education, technology is the commonality across each and every one of those target industries. And how can we enable, businesses to not only optimize the product offering that they have, but in it also work with others to collaborate to enter new markets, to drive new opportunities. We have so many different case studies and examples of, taking companies A's capability, company B, and putting, whether it's a formal joint venture or other structure, whereby we go after opportunities that neither one on their own could have gone after, driving, that growth that I highlighted earlier. So that element of, sharing technology, driving opportunities, optimizing capabilities is such an important part of, what we do. We have resources, right now our portfolio is about 25 billion in revenue in aggregate. We have close to 150,000 people across the globe. And to be able to leverage that has been really important for us as we drive those returns, because that's a resource in and of itself. So it's something that we are focused in on, and we continue to try to optimize.
Yeah, and I think one of the things that makes that approach successful is the fact that, I don't think we'd mentioned it yet, but given our focus, we believe that the only way to achieve alpha, well above average returns, is to have a concentrated portfolio, given our strategic approach to our investments. And so while in scale the entire portfolio is very large, we'll do, I believe in Fund 8, we'll maybe have 7 investments when it's finished. And in our new fund, Fund 9, which, as Ramzi mentioned, will be 15 billion, we're targeting maybe 8, 9, 10 investments. So that's part of our strategy, is to have that concentration to be able to then drive and create that value.
Yeah, we joke, actually, even when we were a $150 million fund, we did a $1 billion deal. So we scratch and claw and figure out how to, optimize relative to scale.
So on the concentration, I mean, one of the questions that came in is, how do you get your organization and teams to become comfortable taking risks of that dimension? I mean, how do you incent them, motivate them to do this?
Yeah, I mean, it is obviously a risk, but at the same time, because of the focus that we have, quite frankly, it's an opportunity in and of itself. And, I'd say, I mean, proof's in the pudding, lack of volatility. I mentioned our loss ratio of less than 0.5%. But at the end of the day, that playbook that I highlighted is something that obviously is important, not only, again, in terms of maximizing opportunities, but minimizing risk. Every single investment has a lot of risk, no matter what type of business, no matter what type of industry they're engaged in. And our job is to obviously mitigate as much as possible that risk and drive opportunities from there. And so, yeah, I mean, it takes a lot. And I always say, what we do is more of an art than a science. And, we did go to Chicago and we learned a lot of the analytics that are important in terms of what we do. But at the end of the day, it's literally, an art of deciding, on a relative basis, not only which deals to move forward with, but, which, how to mitigate those risks and how to expound on those opportunities. And that's a really important part of, kind of where we end up being in terms of, returns we generate for our LPs. Mm-hmm. But the concentration, actually, I view it, and we view it more as actually a benefit, because we spend all of our time on fewer companies versus, going to a board meeting every quarter, and that's the extent of our involvement. We're involved in every single decision that has to be made. And that, there's a lot that occur during, our average 5.5-year hold. And we can do that. And every partner, as Hugh mentioned, is involved in that decision-making. And it optimizes, therefore, the ability to make the most effective decision. I don't call it right, because there's never right, but the most effective decision. And so that wouldn't have been possible if we had 20 companies in a fund. It's just not, and there's some other tech-focused funds that obviously have that approach and works for them. But for us, because we spend so much time in that reorientation of those companies, the reinvestment, the transformation, it could only happen if we had the 6, 7, 8, 9 companies in a fund. So that's really, I think, that concentration is in and of itself a benefit to us.
So in terms of the people at Veritas, what do you look for when you're trying to hire somebody? Like when the two of you I mean, I'm sure you look at lots of people who would love to work for you. What are the sort of the characteristics you're looking for?
Yeah, I think, we
don't always get that right. But
yeah, we make mistakes there.
We try.
Yeah, I think, passion.
Yeah.
The people who have been most successful at Veritas over the last 30 years and what we try to look for when we're recruiting are people who have a real passion for investing. And again, the fundamentals are very important. The knowledge base is very important, but finding someone who has that drive. And I think what we do look for is someone who is going to be able to thrive in the spotlight. We talk about the fact that we've been blessed, given our track record, to have a lot of people who would love to join Veritas, speaking frankly. But not everyone's ready for that spotlight. Many people might have an ability to contribute, but they don't want to grab the mic. You saw Ramzi do this, bang the fist earlier. Some people can contribute on an investing team and play a role. But what we look for here are people who really love what they do. We work 7/24. Technology allows us to do that, and finding people who are not afraid to take the spotlight, bang their fist on the table. And by the way, mentorship is important.
Yeah.
Finding people who, on the junior side, we try to recognize that. And when we're in IC meetings, we pass the mic. The spotlight does shift. And so that training at an early age is, I think, something Ramzi and I were blessed with, going back to the early days of PE, when there were very few associates at any firm back then. You couldn't hide. And, that's one of the key attributes we look for when we recruit. Again, people who have that drive and ability to thrive in that type of environment.
So I presume you have LPs from all over the world, right? I mean, when you think about investing, given that you need to be so connected to the government and having national security clearance, as you said, Ramzi, does that stop you from investing in multiple countries, or how do you approach that?
So yeah, we do have investors from across the globe. Our focus has been, in terms of the investment side, more North American. We do invest, again, outside of the North US, Canada, et cetera, but predominantly US based, and all companies are global. But we have a company, for example, headquartered in Scotland now on the analytics side. But I would say that really somewhat insulates us from even what's going on. You hear about, obviously, all the discussions on tariffs and volatility therein. But from an investor standpoint, we do have restrictions in certain geographies. More so in certain administrations like this one. For example, we don't have any large-scale investors from China. We did at one point, but because of our work in highly sensitive areas and national security, we no longer have that investor base. But otherwise, we have a significant investor base in the Middle East and other areas in China. Asia, and significant investors in Europe and South America, outside of just the US.
And again, our markets here in America are so large, largest in the world. And so there's so much opportunity here, keeps us very busy. And so from an international investing standpoint, we have done many add-ons to platform companies that are American-based and focused. And again, we have an emphasis on investing in product, services, software that are mission critical, the must-haves, not the nice-to-haves. So that allows us to take a very different approach when we look at buying any add-ons, or, as the example of the company in Scotland we recently purchased, evaluating it still from that American perspective. Because even the overseas companies tend to have a majority of their revenue still in the US.
So looking ahead, with all the what are the big challenges that you're seeing investing in government technology, let's say, and how do you make sure your portfolio companies remain, agile, adaptable to whatever is happening in the environment?
I think the challenges are no different than what they were, a decade ago, relative to the overarching government technology kind of ecosystem. It's really, Hugh highlighted it. It's the ability to identify these mission critical must-have technology capabilities and businesses oriented around them. And that's, the important element of what we talk about relative to IP and everybody understanding, that single decision is so important because there are so many variabilities if you don't make that right decision relative to downside risk. And we've seen that, in the markets we're engaged in. But I don't think the problems are any different. They obviously evolve but at a high level, I believe, notwithstanding again what we are all experiencing and what we see across the globe in terms of that volatility, if we do what we know we should do and stay in that lane, one of the things that we've seen in private equity is, a lot of people to grow their AUM, move into areas that they're not as facile and they're not as deep in. And then what happens is you see kind of the returns suffer. Our priority is to provide the top returns. And to do that, we have been steadfast in maintaining kind of our lane and not straying from that. And I think that's a very important part of, successful private equity firms, whatever focus they have.
We talked about fintech. We had another question come in about, can you talk a little bit more about your recent move into credit investing?
Yeah, I'll start it. Yeah. We talked about IP, and that's really, we don't do anything unless there's a strategic rationale to do it. So we were thinking about, and we became close with a luminary in our world, Henry Kravis and actually George Roberts, and they talked to us, this is many, many years ago, over a decade, about, how unique our IP is and, just kind of how do you continue to build on it? So one of the things that we said is, thought about it in that regard many years later is, look, we invest in control. So our flagship fund is, control, equity, ownership. But we see a lot of opportunities in those ecosystems. Obviously there's a credit side to the debt side. So we decided, let's try to see if that actually increases our IP. Investing, having a group that invests strictly in first lien, second lien, mezz, preferred. And ultimately, that led to raising Credit Opportunities 1. We're actually now raising Credit Opportunities Fund 3. And what had happened is it actually did that, not only from an internal knowledge standpoint, but our deal flow increased across the firm. And that also led us to, by the way, raise a separate vehicle, what we call Vantage, a middle market fund, because as our flagship grew, we didn't want to, again, vacate the space that we had a lot of success in. And so we raised a $1.8 billion Vantage fund, and we're about to start raising a $2.5 to $3 billion Vantage fund focused on middle market opportunities, again, in these target industries. So the decision to get into credit was strictly to, leverage this IP that we have, and it's been a very successful, platform part of the firm.
So again, what are sort of other areas you might potentially go into if you're able to say it in the next, let's say, 5 to 10 years?
Yeah, we think about that a lot. I mean, we will only go into something if we think that it increases and enhances our position as a firm, our IP. I mean, there's thoughts about, growth equity in areas like national security and healthcare tech. And so, we consider a lot, we look at a lot, but we will only do so, as I said, if it is for the greater good of the entire platform. But that's one area that, we've thought about, for example. Infrastructure is another.
That's another one.
Yeah.
Maybe could you say a bit about infrastructure? I know that, a lot of companies are trying to get into it, like, BlackRock and others, and just your thoughts on that would be interesting.
Yeah, I think one perspective, and one of the challenges we have when looking at infrastructure is, the return profile is completely different.
Yeah.
When you're looking at buying, whether it's ports or airports, like GIP has done very successfully. You're excited about a high single digit, low double digit return, but over a much longer period of time. Whereas you heard Ramzi walk through the stats of our track record. It's a very different business. We're targeting 4 times plus returns, mid 30s IRR net returns. It's a different investing profile in the infrastructure world. It could be something we consider. Again, it would take a different set of LPs, same LPs, but different divisions within those LPs who who have a lower but longer term IRR threshold, return threshold. But we'll never say never, but again, it has to happen at the right strategic time and have the ability to leverage and increase our IP.
Thought maybe I'd move to some more personal questions, if you will. I mean, who are people who have mentored you, or given you sort of advice that you found very useful in your career?
Yeah, and Hugh and I talk about mentorship. It's so important. It has been important to us, obviously, and it's important to, again, as we mentioned, folks here at the firm. So I look to typically, two people. My father, just seeing firsthand, the work that it took, the risks that he took, just, not only coming to this country and doing what he did on his own, but then ultimately building a business. And, that I think has had a lasting impact on how I view the world and how I actually, act in the seat that I have today. The other gentleman is someone by the name of Jay Pritzker. Yeah, again, during my experience at business school, I actually worked for most of that time, and I worked for the patriarch at the time, Jay Pritzker, and I saw a lot. It was very enlightening. I actually worked with Mark Hoplamazian, who you mentioned earlier, now CEO of Hyatt, as well. But I worked literally most of my time was spent with Jay, and he taught me a lot. One of the things from an investment standpoint that he taught me is really, and this sounds, it's a lot harder to do than it sounds, but to keep it simple. Your investing there's so many complexities that go into a decision. It's really imperative to try to distill what really is important, what really matters, into 2 or 3 things, and then really focus on those, not only to make the decision, but then ultimately to make that investment a successful one. So, I look at, Jay, again, as someone who left an indelible mark on my career.
Yeah, similarly, we both had fathers who cast very, very long shadows during our lives, even to this day, even though they're no longer with us. I was fortunate at Merrill Lynch Capital's partners right out of school to have 2 mentors. One who actually might be listening in. But mentorship is critical, because this is an apprenticeship. There's no black box, and you can learn a lot at school, but there's no algorithm for how to be a successful investor. It's really a mosaic where you're taking pros and cons and learning as you go through your career. But I think being able to understand the importance of fundamentals was something I learned from these gentlemen. But as well, relationships are critical. I'll never forget watching one of my first mentors back in the early 90s in the cowboy days of private equity. One's a very large, well-known name today in private equity, but he was going after a deal, and the bids were in, and his job as a vice president was to go pick up the CEO of the company and his wife to take them to dinner, and the CEO got delayed. And so he had to spend quite a few hours at the Plaza Hotel with this gentleman's wife. And the next day, when the CEO decided with the shareholder who to sell the company to, he actually remarked that that person showed integrity, cared about more than money and deals. And so before he went to the board meeting to make the decision, his wife says, "Perry Pasu, if I were you, I'd choose that young man's firm." And it's important. We get all caught up in numbers and returns, but relationships in this business are critical. It's ultimately a very small world, and your reputation is paramount. And that's what's great about going back to business school, is the chance to kind of broaden your relationships. And look no further than, there's many examples, but there are 2 sitting right in front of you right now, that one of the advantages of business school is to be able to open that relationship aperture.
You both mentioned that you're a 24/7 company. So one of the questions was, how do you think about work-life balance, and what are the things you do to sort of help stay grounded?
Look, I think to get to where we are, you have to have that balance. Otherwise, it just you won't, I don't think, ultimately be successful in whatever whatever you do. So, for us, it's the ability to compartmentalize, it's the ability to, we know what our priority is. Our family is our priority. And we share that, and kind of another element of the culture here, we prioritize that. And yeah, I mean, we obviously, as you mentioned, we continue to, drive the firm, and we continue to be, again, 24/7 doing it whenever we need to do it. But at the same time, that balance has been a kind of a pillar and a linchpin for us, because if I didn't have, the family around me and the support that I've had, I wouldn't be able to, do what I do on this end. And quite frankly, it's kind of symbiotic in that, the firm life has enabled and provided for opportunities that my family would not have had otherwise. But, we know what's important. We grew up as we highlighted, in a setting which foundationally taught us what is important, and we haven't forgotten that.
And we were also lucky, we laughed, that we also had very strong, involved mothers who were not afraid to knock us down, nor our brothers.
Yeah.
Earlier in our careers, if we ever thought we were a little too special, that ended quickly with a call from mom.
And by the way, the moms continued to do that with us. So, that's a good point.
So what legacy do you hope to leave, sort of within Veritas, within the broader business community? How do you think about that?
I mean, at the end of the day, as I, kind of hopefully highlighted, it's about the ability to make a difference. I think we all want to make a difference in whatever we do. And I think, through our investments, through our company, through our vision, through our, again, efforts, to make a difference for people, not only internal to the firm, which is very important, not only to the 100,000 plus employees of the companies and their families, of the companies that we own, but importantly, citizens and folks across the globe, through investing in areas that matter and trying to do good through those investments, making sure that we enable technology, as I said, to help protect citizens. By the way, just on that matter, it's now declassified, but one of our companies was actually directly involved in the geospatial intelligence that led to the capture and ultimately killing of Osama bin Laden. So, the ability to make a difference really does matter to us. And I think ultimately that's really what I hope, kind of the legacy will be.
Mm-hmm. So one last question. I mean, I know that you all have a share of AC Milan. Was that a private investment? Was that through Veritas? How did that happen?
No, that's a private.
Private.
You and I actually spent a lot of time while we were in Chicago on the basketball court. So we are big sports fans. We want to actually delve further into the sports world. This was an opportunity, again, not on the Veritas side, the private side, to do that, to start learning more about that, in that case, the football ecosystem in Europe, and specific Italy, which is very unique in and of itself.
Yeah.
But we strive to, we're looking at opportunities across the, the 4 major leagues, and, hope one day actually be in a more of a control position for a sports team down the road.
Okay. And this is something the two of you did together?
Yeah.
Well, we're out of time, but I just want to thank the two of you. Well, first of all, congratulate you on just doing an amazing job, being great successes, really making the school proud that, we can call you alumni. But I want to thank you for taking the time to come back and being so open and honest in your answers, and really helping our community with your feedback. Would love to see you in person back on campus, or I will come and visit you in New York. Thanks again for taking the time, Hugh and Ramzi.
Thank you, Mata.
Thank you.
Thank you.